Welcome to Striking Option. The show reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Scott Barr. Welcome, Scott.
Jeff, how are you?
Well, I'm doing well. Really interesting to see the market's historic day. We're seeing treasury yields go lower. We're seeing a circuit breaker set off the S&P 500 being down 7%. And this is all in the wake of this OPEC Russia type of scuffle over pricing or curbing production. So now, when the market's down so low, do you see continued volatility as volatility is very heightened?
Volatility absolutely is going to continue, whether it's for days, weeks, months. It's going to continue, probably not at the frenetic pace that we've seen over the last few days, but absolutely will continue.
And this is really unexpected, Scott, as we've been dealing with the coronavirus fears, which have really pulled the market back. Now we're seeing a kind of a 1-2 punch with this OPEC news over the weekend. So the market, the S&P 500, down nearly 20%. Are we going to be going into a bear market? I think is what the market is looking for.
Well, whether you call it a bear market or pre-recession or just a major sell-off, you know, this is a period of time that's incredibly interesting. And I don't know that anyone really has a handle of where we're going to be a month from now, let alone, you know, next week.
I think that's a great point. Let's get this first lightning round. Are you ready, pal?
Absolutely.
Well, the E-mini S&P 500. Well, we just talked about the historic move lower. Now we're almost in a bear market. So what type of approach would you potentially take as you see in the market nearly down 20%?
You know, with the market coming 20% roughly off of its highs, if a trader or investor wanted to add some exposure to the marketplace here, a trader could sell the March week 4 2750, 2650 put spread in the ES. Now, the selling of this put spread allows an investor to collect $1,648 because of the extreme amount of volatility in the marketplace. This put spread does expire on Friday, March 27th. It's tied to the June underlying at 2767. And like I just mentioned, at the money volatility is 57.99.
Truly remarkable to see volatility that heightened, and that is the reason why you're able to collect such premium on this. And it's interesting, if you would have gone just last week when we closed on Friday, this wasn't an at-the-money put spread, and now it's an at-the-money put spread due to the fact that that circuit breaker went down 7%. It was set off this morning.
Exactly.
Well, Scotty, since you presented a bullish approach, I'm going to take the other side of the fence here and have a bearish side because we may have more movement to the downside. So my thought process was, or my approach, was that I'd be a buyer of a put spread. Looking at the March week 4, same expiration as you, buying the 2650 and selling the 2550 in the E-mini S&P 500. This is a defined risk approach. I'm trying to mitigate risk if we do see us go down and test another circuit breaker. This will cost an investor about $1,260. And again, this is an expire Friday the 27th. And that June underlying at 2767, that at the money volatility sensationally above 57.
Right, so it is a bit more expensive because of the volatility. However, you're going to explain now what the actual notional value of that is that an investor can really look at to try and hedge some sort of a position.
Yes, and if you look at a typical one line, the E-mini S&P 500, roughly about $150,000 of notional exposure. So by buying a put spread, buying 126.50 and selling 125.50, you're trying to mitigate that risk, looking for that put spread to fill in the event the market goes lower. So it's all about risk mitigation, understanding what you're paying for that. And yes, as option premiums are very elevated, I think in this moment in time, you have to look at both the bullish and the bearish case, Scotty.
No doubt about it. And both of these, types of approaches here are completely risk defined, which in my opinion is the key.
All right, well, Scotty, thanks as always for coming on Striking Options. And please tune in every week as we will continue to strike options.